If you're an investor and you own rental property, then you've definitely had a vacancy at some point, and you know that a long vacancy can really hurt your cash flow. And it's frustrating for you as the owner. It's frustrating for the property management company if you have one. Or if you're a DIY investor, this is going to be extremely helpful for you to get some insights onto what's happening in the marketplace as I take you through a recent report put out by RentEngine. Shout out to the guys over there. It's a really good recap of where the market's at and what you need to know as an investor to fill your vacancies quickly. And this is stuff that I presented on, and I thought this would be great to share with you guys in the marketplace. So, going to go over a few things for 2026 leasing market trends, a couple of things that I just think is a good thing to recap on as an investor. Whether you're doing a flip or new build, you still get some value from what we're going to talk about today, and how you guys can stay connected to us in the future, different content that we put out, so you guys can stay updated. Again, whether you're a client or not, doesn't really matter to me. So, background: Marine Corps veteran, born in Tampa, been doing property management for about 10 years. We have our real estate brokerage, which is mostly residential agents, but 99% of my time spent on the property management company. I also invest. So I always tell clients, hey, our same process for what we do on rentals is what we do for our clients. And wife has an architecture company. And you might be hearing this on YouTube, but want to make sure that you also check out our podcast, the Tampa Bay Veteran Investor. So all of the interviews that we do on the YouTube channel also gets published on the podcast. So if you're driving around or you just want to pick up where you left off, that's something that you're able to take a look at. So something that every investor should be paying attention to, whether it's sales or rental side, is interest rates. So right, so CME Group is a website where you can just look at the Fed meeting minutes, the upcoming Fed meetings. So at the top of the screen here, these are screen captures from the website. Basically, you can see the upcoming meetings and the probability of an interest rate change. So this is just helpful. Obviously, people don't buy properties when interest rates are higher, don't buy as much. And so higher interest rates can be a benefit for rental investors because tenants may stay in place longer. But if you're buying properties to sell them, flip them, this is something that's going to be an uphill battle for you on being able to sell your properties quickly. So I just wanted to kind of point out the difference between where we're at today, that there's really the upcoming meeting. There's a 99% chance of no change in the interest rate. But what's cool is that it'll let you click through the upcoming meetings and see the likelihood. So here I have 9th of December selected. And what's the probability of a no change there? Still pretty high, at least 50% no change. So probably not going to get a lot of reprieve this year, but we don't have a crystal ball. But it's good to know, good to think about, hey, if things are still slow this year and I'm thinking about selling a property, my price might need to come down because interest rates are high and a new buyer coming in is just not going to be able to afford it. So if it's an investment property, sellers I think are starting to realize a little bit more of what reality is. But on the rental side, okay, hey, maybe that's good for rentals in the short term where residents may stay and place longer, or they might continue to be just more price sensitive and downsize on some of their rentals. So like I said, RentEngine did this leasing report every quarter. There's some different softwares in the industry from a leasing standpoint that do these, and it's really good for you. Most of the time, I don't think you have to be a client to log in and be on them, but they were kind enough to share this. Normally, you have to be live to be able to view this information. So I don't know if this is really released other in this sort of format, but appreciate RentEngine's team for doing this. And some of the information later, I also want to give it a shout out to Brian Chavis, great real estate investor, multifamily guy, local to the area here as well, has a book called Buy It, Rent It, Profit on Amazon. Blue cover. I'm going to go through and share some of the due diligence items just as like a final piece to the presentation that we like, and some of that we've grabbed from his content. So going to take you through the leasing report here and give owners and investors an idea of what's happening in the marketplace. So RentEngine has a little bit better speed on vacancy compared to some of the other stuff that we see in the market. So on a national basis, I was just at a conference a few weeks ago. We're seeing 45, 50, 55, 60 days on market. Of course, it's going to depend on the market, but broadly speaking, every property management company is dealing with a challenge when it comes to vacancies and them just taking long. So even if you're using great technology, you're still going to be a little bit of an uphill battle. It could depend a little bit on asset class, how many bedrooms your property has, which we'll talk about a little bit. But generally, it's still something that a lot of people are experiencing. especially if you're in multifamily and you're competing against properties that have amenities and yours don't. Can be a very big uphill battle for the incentives that these big Class A guys are offering that might be pulling your residents over. So that's also something, supply and demand, right? If the guy down the street has the same 2-bedroom apartment or the same 3-bedroom house on the market for less, it's kind of a race to the bottom, assuming that your property conditions similar, right? So back in the day, we used to have a leasing guarantee within just a few weeks, and the market's just changed so much where it's, it wouldn't be setting the right expectations to say, hey, we can still fill your unit in 2 to 3 weeks. That's just not the average that we see. It still does happen, but right now we want to give owners a realistic expectation of what vacancy time looks like. So definitely most properties are going at least 30 days. Again, it comes down to what the owner wants to do as far as pricing. If they want to be more aggressive, that's better for everybody. We'd love to have low vacancy. We've actually started offering up to $250 as move-in credits. That's just out of our own management pocket across all assets. And normally you don't see that on all assets. You might see that on multifamily, a 1 month off, a 1 month free, reduced deposit. We're trying some of that and even the single family space to try to buck the trend a little bit. But low 30 days on market, that's kind of the average. If something's over 60 days, something's probably definitely wrong, either property wise, the pricing just started way too high, or some other impact, maybe on the street. Unfortunately, sometimes neighboring properties can be a deterrent. So long days on market, right? That's something that every owner's just needs to know about. And not only that, but you're also going to probably have price decrease. So properties that are renting for $100 to $200 less than they used to. So it's another reason why you really want to keep residents in place. So days on market not going down anytime soon, has been consistently increasing over the last 5 years. And there's a little bit of seasonality to it, but again, overall, it's still on the uptrend as far as longer days on market. This is going to give you some perspective on how important it is to price it right from the beginning. So our philosophy right now is if a property is going to rent from $2,000 to 2,200, going at the $2,000, do 1995, be on the more aggressive side, and making at least weekly adjustments. Probably not longer than waiting 14 days to make an adjustment. But you can see that the more price changes somebody's had to do, the longer days it's on market, which just means that they overpriced it from the beginning, right? So if you price it right, you have a really good chance of beating that 30-day timeline. We try to be pretty aggressive with most of our clients, and we even on the bottom end, and it's still taking some time. And you're doing the professional photos, you're offering self-showing capability, which means the resident can go see it by themselves or accompanied with a person from our staff. You need to be doing everything when it comes to technology to decrease this. But pricing is so important. You just need to drop it $100 versus have another 1 or 2 months of vacancy. So don't trip over the small decreases in price. Just get a tenant in. Again, this hopefully a short-term thing, and on renewal you can always bump them up. Market might change a little bit, but something to be mindful of, that it's definitely a challenge and everybody's feeling it, as well as us on our own rental properties. This is simple, and this isn't the full report. I just hand selected 10 to 15 slides. The report I think was 50 or 70 pages, so I'm just gonna pick out some of the ones that I wanted to present on when I was speaking the other night. So by platform, just kind of gives you some perspective on residents that are reaching out, having actually completed showings and submitted applications. Different platforms that people are seeing, you can kind of see Zillow, Rent.com are a big one. RentEngine's, obviously a great leasing platform and converting pretty well. So you got to be where the residents are from a marketing perspective, especially if you're a do-it-yourself investor, making sure you have an easy process for residents to apply on your properties and get them approved or denied quickly so they don't leave to another property if you take too long to process applications. This is one thing that we want investors to think about when they're buying properties for sure. If you own something, you can't really do anything about it, right? But if you're looking to buy a single family house, multifamily property for investment, it's good to consider to try to get into a more optimal bedroom size. So we have some properties where the location's really good and you can get by with a studio or one bed that leases pretty well because of the location and the affordability of that. But generally speaking, if you're, let's say you're going to go buy a duplex, if you can buy a 2-bed or 3-bed on each side, it's going to be much better than a studio or 1-bed, because obviously over time, families grow and they're just going to move up and move out. So we would say most investors that have 1-beds or studios should pencil in a higher vacancy rate over time just to account for that. And as the data shows, even houses that are bigger, most of the houses that we see that would be 4 or 5 beds are typically, an owner used to live there, they moved out and rented it. We don't see a lot of investors actively buying houses as rentals, but it's something to think about. Or if your flip is taking too long or the values aren't there because it's a soft market, you might have to rent out the property for a year. But ideally, if you're building properties, buying new rentals, if you can, if there's supply on the market where you can pick, there's a better way when it comes to beds and baths and square footage. This one's going to show you just median leads by property type. So single family, townhouse, condos, multifamily is really competitive. So that could be one reason why the lead flow might be down or look less on multifamily. Is just the competitiveness in the marketplace. But again, we like multifamily because if one resident's not living there, you got still somebody that's paying the mortgage. But a little bit of difference, obviously, by asset type when we're thinking broad, national market. And then from a leasing perspective, most people that rent, they may not have the deposit. They may just be new to the area. They may want some sort of amenities or lifestyle that they can't get in a single family house. But generally, most of the credit scores companies are going to look for is probably north of 600. But most of what we see is that 630 to 660 is probably like where the average score. And so, according to the data here, it's in the mid 630s. And again, that shouldn't be really surprising to anybody. I mean, you do get some people, again, depending on the price of rental, you might see higher incomes too, or not only, higher income can translate sometimes to higher credit. That's not always the case though. But generally, most of the properties we rent are anywhere from 1,200 to 3,500, something like that. And this is just an average that they're seeing in the marketplace across hundreds or hundreds of thousands of units and residents that are applying. So just good to know. Should be giving you decision making capabilities when it comes to your rental screening criteria. If you're 3 times the rent, maybe you want to do 2.75 or 2.5 times the rent as household income with a bigger deposit to try to get more residents in when it's such a leasing market. Or your credit, maybe you're typically wanting people that have over 700 scores or 675. You may be willing to, even in the short term, apply that across all your properties so you don't get discriminated against and use that as ammo and information that might help you lease quicker than the guy down the street. One thing we've been doing for quite a while is offering self-guided tours. So resident has to, submit ID. There's ID verification and stuff that we go through. I've been really fortunate for, a long time now to not really run into a lot of issues of somebody, vandalizing the unit. Never had that on a self showing. So this is important because if someone wanted to book a showing an hour from now and your team's tied up and can't get to it, it's so important to get that lead showing a property within 48 hours, 72 at the max, before the potential of conversion goes way down. So you should have flexibility in the technology, or the company that you work with has flexibility in the technology to have people do self-guided tours. If your property manager is out of town and there's nobody to show it, then what do? Right? So it just gives flexibility. But I think a lot of owners would think that naturally accompanied, having somebody there in person converts better when it's not necessarily the case. So this shows kind of days on market between self-guided actually maybe being a little bit better than accompanied. We do both. Some owners are like, hey, I just want a company. That's totally fine. Also, if a property is in a more challenging area, a lower income area where there's just might be more crime or different things that we have to look for, we may not want to do self-guided in certain areas, but it is something that we think everybody needs to be doing. And the big institutional companies have been doing that stuff for a long time. So that's one thing too, is we follow the big multifamily guys. A lot of their things that they do, they have massive budgets, massive technology. We pay attention to what they do to make sure that we can service our residents and owners in a similar fashion. So this is going to show the lead time. So your completion rate, or a completion rate of having showings completed by residents by days, lead time to when they book the appointment. So most of the people, if they can see the property within a few days, it's going to have a much better chance of converting than somebody that books an appointment 10 days out. Like, they're probably not even going to go to the appointment, probably going to get a cancellation. So it just speaks to flexibility in leasing, right? If you have people available, great. Self-showing needs to be there, because if you can't make it and you're having to push showings out further than 3 days, if it's, set up between you and the resident, that's like, you're both agreeing on a certain time. But the point is, you got to get people, sell them on a quicker showing, get them into the property within a few days of them reaching out, and you're going to have much better conversion rates. And when you are converting them, obviously, even if you're doing self showings, you still need to be going by the property to check for the windows and the safety and the cleanliness and just stuff that can happen. AC goes out and nobody knows until the next showing, right? So you'd always still need to have an inspector or somebody going by to check routinely on that sort of stuff. But this is the low hanging fruit is, great paint in the property, the lighting, cleanliness, there's no weird smells. All that is going to matter much more than a potential layout of the property, the appliances, whether it's stainless or black or amenities on the property. So you can have a big challenge with your property if it's not clean, which is obvious. But even if you had it deep cleaned, roaches, bugs, cobwebs, whatever stuff can happen. People track dirt through. A realtor shows it doesn't clean up after themselves. So cleanliness being one of the major things that people will turn them off from your rentals. And so much of what we do happens after hours. So over to 50% of the people that are going to look at properties, or so I should say book properties, are going to happen after hours. And even with self showings, you can limit the time window during the day so you don't have people looking at properties at midnight, right? But everyone is going to be booking stuff after hours. Saturday is always the busiest day for elite, showings as well. But you basically, summary is you need to have a way for people to book appointments after hours to see the properties during working hours. But that's when people get off work and look at stuff. So that kind of concludes most of the slides that I wanted to go through for the RentEngine report. Here, I'm just going to talk through a few things where you've probably seen it in other videos, just to give you a little bit of perspective of how we're thinking about the current market. So if you're flipping properties, you're doing new builds, rental needs to be a plan B, because we had a property ourselves in the last 2 years where renovation went a little bit long and I just had to rent it out for a little bit and sell it in a better market, or the values have come soft and the appraisals just aren't coming in where you need. And even if it's something, again, short term that you have to rent out for a year or two for the market to improve and not just be bleeding out hard money payments or mortgage payments every month, have a plan B. At least know what the rents are going to be if you had to rent it out, so you get ahead of it. We do work with developers that are doing tear down stuff. So if they're buy a property, you plan to tear it down, you got tenants in there, and it's a drawdown process, something that we are interested in and have seen a little bit more in the marketplace. Renewals are super important, right? So we talked about keeping residents in place being extremely important because vacancy is taking longer. But you not only have the cost of the vacancy from a time perspective, but the repairs, right? And you're hoping that the deposit covers the repairs. But even then, you're going to have curb appeal improvements that you're going to want to make that you're not going to be able to charge the tenant for. So super important. We're starting to do a little bit of increases on some of the renewals, but most of them could be staying flat with very moderate, like $50 increases. But the thing is, keep your tenants in place. When it comes to CapEx, which is capital expenditures, we think of maintenance in two ways: your general maintenance while the resident's living there, and your CapEx, which could be your roof, water heaters, electrical, plumbing, whatever, HVAC, and or other things that you might do to the property, like signage or a big landscaping job, like a one-time kind of injection of cash that doesn't happen every year is an easy way to think about it. But plan for that stuff ahead of time. If you think the roof only has 10 years left, just be setting money aside or thinking about that ahead of time so it doesn't come back to bite you. And be proactive with some of the maintenance versus reactive. We always think proactive AC servicing is a good thing. If you just set that up on a once a year, twice a year plant maintenance plan, that's a simple example of something that's kind of add longevity and is a smart investment. When it comes to the turnovers on units, we're trying to get the minimum viable product to get the unit rented right now. A couple of years ago, you could do a $10,000 renovation on a 2-bedroom and probably get the $200 to $300 rent increase. That's not the same in today's market. You're almost having to invest and upgrade the unit just to keep rent the same, or not from falling. So that's the thought process that we're going through with all of our clients: is how can we turn the unit the quickest for the lowest investment to have a good product, and usually discouraging clients, at least right now, on investing a ton because they're not going to get the ROI that they're looking for, but they may later down the road. Fast reductions on price. We talked about that during the leasing period. And just find people that you value their input on the market. So podcasts, YouTube, newsletters, which we'll share some resources for you guys as well to make sure that you get different points of view and you don't hear it just from us. You're paying attention to other people as well. Maintenance costs. have easily doubled on some stuff over the last 5 years. So just an owner's expectation of maintenance needs to change. Where the water heaters used to maybe get them done for $1,000, and now you hire a plumber, they're going to charge you $2,000. Handyman, maybe less, 1250, 1500, 1750, depending on size of things. It just depends, right? But budgets for maintenance need to be more, especially if it's short-term rental, mid-term rental stuff. Room rentals probably need to budget higher. Lower income areas, we typically just need a higher maintenance budget, usually because the property could be deferred, not necessarily that it's a resident issue. But if you're buying a property, I would be underwriting a higher than 10% maybe maintenance budget on an annual basis. Of course, depending on the property condition or how recently it was built, but nonetheless, costs are increasing. They're not going down when it comes to maintenance. We use a lot of AI and automation and things that we do as a business to make things most effective. But there's a lot of great tools out there for underwriting, due diligence. If you're going to be, obviously, you have a home inspection report, you could put that into a program and ask it a bunch of questions or what you should negotiate. You could even just get a huge due diligence checklist off of ChatGPT or one of these platforms that could be very advanced and give you some extra ammo, things to think about when you're buying properties. You need to negotiate because your money's made when you buy, not when you sell. You got to make sure you get a good deal on the front end, and it's a buyer's market. So if you're buying properties, you should have the leg up on the seller right now in most situations. But like with anything, any investment properties you have, you got to evaluate your opportunity cost. So if you have 200 grand stuck into a property that's making you 5% or something that's not super great, you may just need to sell that asset, put it into the market, maybe stocks or something for a short period, or reposition it into something better. Or you have a house that's in a lower income area, but you have some good equity. You may want to sell that and just reposition into a duplex or better area or better newer property with better tenant demographics and stuff. So always be thinking about, are you using the leverage the best? Should you refinance? Should you do an investment HELOC and pull some cash out where you don't want to sell it, but you'll need to still access some cash and maybe have enough cash to pull out to go get another property, but you don't want to refinance because you have a really low rate. Just like with anything, you need to always be analyzing opportunity costs. And, with single family, you don't have a lot of levers you could pull, but insurance is something that anyone can always be shopping around. We are seeing a little bit of decrease on some insurance policies. And of course, work with a good CPA from a tax standpoint, making sure that you're not, especially if you have a high W-2, you're not getting smoked on taxes. And over time, we've kind of learned that, hey, newer properties, better areas is going to be a better long-term investment than having to just buy properties that promote a high net income and low income areas. So if you can spend a little bit more, get in a better area, get a better property, a newer property, over time, it really matters. So there's one thing that people can use us as property managers for, due diligence. If you're buying properties, of course, your real estate agent will help with some of this, but they don't do what property managers do. And we have a lot of ammo we can bring to the table when trying to negotiate better prices or understand that you're just making a smart investment and things to be looking for on your rental properties. Again, single families are a little bit more cookie cutter, not as complex, but different types of multifamily could get very involved on stuff that you want to make sure is in place or records that you ask for to really understand the history of the property and how it's going to perform and if it can perform to meet your investment goals. So there's 3 ways that we'd love to stay in contact with everybody. My information is on screen. We have the YouTube channel. If you scan the QR code, that's going to take you to our newsletter, which is mostly for private clients that we have. So you'd be able to get some perspective of just stuff that we share monthly from there. And of course, the podcast as well. But on the YouTube, we also share a lot of educational content. And then we do interviews. We do at least 1 or 2 a month of hard money lenders, tax attorneys, CPAs, cost segregation guys, self-directed IRA. We just had how you can invest in real estate with that. So a lot of different topics, just keep you guys updated on what's happening in the marketplace, give you a better perspective of how to be a better investor and how we think about stuff as, being in the area for a while now. So thanks for watching. Have a great day. Please subscribe. Thanks.